What a week it has been for silver. After one of the most dramatic sell-offs in recent memory, the white metal is climbing back. And today, February 22, 2026, the market is sending some very interesting signals. Whether you're a seasoned precious metals investor or just getting started, this is an update you absolutely cannot afford to miss. Welcome back to the channel. I'm glad you're here because today we are breaking down everything happening in the silver market right now. The price action, the macro forces, the analyst forecasts, and most importantly, what it could mean for your portfolio. Let's get into it. Let's start with where silver is sitting right now. As of today, February 22, 2026, the spot price of silver on global markets is trading at approximately 84.55 per ounce, and that represents a gain of roughly 5.58 compared to where it was on the morning of February 21st. That is a meaningful single-day move. Over on the MCX futures market in India, March silver futures are trading near RSI2, $69,000 per kilogram. Now, to put that number in context, you need to understand just how wild the last 3 weeks have been. Silver hit an all-time high near RSI10 lakh per kilogram, or roughly $121 per ounce on international markets, on January 29th. Then it collapsed. We're talking about a drop of nearly 50% in just days. That kind of volatility is almost unheard of. Even seasoned traders were left speechless. So why did it happen? And more importantly, is the recovery we're seeing today the real deal or just a dead cat bounce? To understand today, you need to understand last week. Silver's parabolic rise in January was driven by a perfect storm: geopolitical tensions in the Middle East, aggressive investor inflows, speculative activity from traders in China, and broader safe haven buying as confidence in the U.S. dollar began to wobble under fiscal pressures. U.S. Treasury Secretary Scott Bessent publicly attributed the extreme swings in the metals market to speculative activity, particularly from Chinese traders, describing the January rally as a speculative blow-off. That characterization is important because it signals that regulators see this as a market distortion event, not a fundamental repricing. Compounding the sell-off, the CME Group raised margin requirements on metals contracts by 2 to 4 percentage points, which exacerbated forced liquidations and margin calls among leveraged positions. Spillover from $1.7 billion in cryptocurrency liquidations and a repricing in tech equities further amplified the sell-off through correlated margin pressures. In short, it was a speculative blow-off followed by a mechanically driven crash. The fundamentals of silver didn't change overnight. What changed was the leverage in the system. So what's changed this week? A few things are working in silver's favor right now. First, macro data is softening. Weaker U.S. economic data shifted expectations toward easier monetary policy, with December retail sales unexpectedly stalling and the GDP control group falling 0.1%, reinforcing signs of slowing demand and easing inflation pressure. The softer consumption backdrop has lowered rate expectations and improved the near-term policy outlook for non-yielding metals like silver. Second, safe haven demand is back. The recovery is being reinforced by expectations of another year of structural market deficit and resilient investment demand, even as traders navigate volatile rate cut pricing after the latest Fed minutes. Third, the Fed rate cut narrative is alive. Markets are currently pricing in roughly 60 basis points of Federal Reserve easing by the end of 2026. 2 rate cuts are now widely expected. That is a significant tailwind for silver, which pays no yield and therefore becomes more attractive when real interest rates fall. And fourth, rotation away from the dollar. There is growing investor concern about U.S. fiscal policy, rising debt levels, and long-term dollar devaluation. That is pushing money into hard assets. And silver, being both an industrial metal and a monetary asset, sits in a uniquely powerful position to benefit. Here's what makes silver's story in 2026 so compelling beyond the short-term price action. The structural setup for this metal is arguably the strongest it has been in decades. The Silver Institute forecasts a 67 million ounce deficit in 2026. The sixth consecutive year the global market has been in deficit. As a result, the market relies on stored silver reserves, adding pressure to an already tight supply. Total global silver output is projected to increase 1.5% in 2026, reaching a decade high of 1.05 billion ounces. Mine production is expected to rise modestly to around 820 million ounces, supported by stronger output from existing operations and recently commissioned projects. Recycling is also expected to climb, surpassing 200 million ounces for the first time since 2012, as high prices incentivize scrap selling. But even with all of that new supply, the market is still short. Why? Because demand from the industrial sector is relentless. Solar panels, electric vehicles, semiconductors, medical devices. Silver is embedded in the clean energy transition at a structural level. J.P. Morgan's forecast notes that silver's role in the industrial sector and as a safe haven asset when volatility spikes are both central to their 81 days to average price projection for 2026. J.P. Morgan Global Research now expects silver to average about 81 per ounce in 2026, more than double its 2025 average. That's a significant call from one of the most influential banks in the world. But they're also being honest about the risks. Their analysts are warning that the silver market remains vulnerable to corrective pressures, especially if prior price rises were driven more by speculation than real industrial need, and they cite high volatility as a key risk. From the technical side, silver is at a critical juncture right now. If the price holds above key support, the market may continue to consolidate within a narrow range. However, if it breaks below the $70 per ounce mark, selling pressure could intensify. And in a negative scenario, prices could even retreat toward the $50 region if selling pressure is strong and prolonged. That is the range we are watching. Bulls need silver to hold above $80 and eventually reclaim the $90 to $100 zone. Bears will be watching for cracks in support and a retest of the February lows around $70. So, what's the takeaway for investors watching this right now? Here's the honest answer. Silver is not for the faint of heart. This is a market that went from $29 an ounce in early 2025 to over $121 an ounce in late January 2026, and then gave back nearly half of that in a matter of days. If you are investing in silver, you need to respect the volatility. Position sizing matters. Never put more into silver than you can afford to see swing 20% in a week. That said, the structural bull case for silver is very much intact. 6 consecutive years of supply deficits, surging industrial demand from the green energy transition, a Federal Reserve that appears to be on a path toward easing, and growing concerns about fiat currency devaluation. All of these factors point in the same direction over the long term. For long-term investors, this consolidation phase, while painful, may actually represent an opportunity to accumulate at prices significantly below the January highs. That's your silver market update for February 22, 2026. Today's price of approximately $84.55 per ounce represents a recovery, but the market remains cautious and volatile. Keep your eyes on the upcoming U.S. jobs report and inflation data. Those will be the next major catalysts. If you found this video useful, please hit that like button and subscribe so you never miss an update. Drop your thoughts on silver in the comments below. Are you buying the dip or waiting for more clarity? I'd love to hear from you. Until next time, stay sharp, stay informed, and trade smart.